Okay, peeps, welcome back. So today we're going to be talking about three key reasons why patience is so important in investing. Let's get it. So the first reason why it's important to be patient in investing, especially basically in any type of investing, but I would say especially in dividend investing, is because markets are bullish more often than they are bearish. You guys got to keep this in mind when you're taking a look at your stock prices. Stock prices are down. You say, oh, my stock price currently is down 19%, as you guys can see here on Tesla on our main portfolio. You guys can see that the cost basis on this is pretty low below the actual share price. The reason being is because we just simply have been putting our money elsewhere, so we haven't bought into these as much over the last couple of months as we have in our other portfolios. We have the same issue in Webull, but again, our main concentration was on our Robinhood portfolio, not on this one. So, Tesla and Tesla are in a downtrend right now because of many different things, including market sentiment. But here's the key takeaway from this that I want you guys to realize. If you look at the charts from a macro perspective, on the weekly, you guys can see that over time, markets have typically ever gone up, and on occasion, they'll have, on smaller time frames, a pretty large pullback, but on big time frames, it's like a blip on the radar. So I'm going to show you guys what I'm talking about here. Statistically speaking, markets are bullish roughly about 2/3 of the time compared to them being bearish about 1/3 of the time. So just understand that when you're taking a look at your stocks being down and or up in either direction, understand that the markets typically are far more bullish than they ever are bearish. But on occasion, you'll have some of these huge pullbacks here, like you see this one from the all-time high all the way down to the bottom is a pretty large pullback, about 27%. That's just on the index, so anybody that was invested in index funds would have felt this. But anybody that was invested in Tesla would have had a 75% drop. If you were invested in Meta, let's just take a look at Meta real quick so you guys can see what I'm talking about here. Meta got absolutely smashed, so index funds in this case were much safer than big tech stocks in some cases, with Meta and Tesla having been down 75+% last year during the technical bear market. So I'm actually going to zoom out to higher time frames here, which is something I have not previously done on this channel. So we're going to go to the 1 month. As you guys can see, the 1 month paints a much different picture. You can see it's literally pretty much just going up. We're having kind of this almost potential, I believe it's called Elliott waves. So it's where you have like a 1, 2, 3, 4, 5 move, something like that. Or we could just simply be creating higher highs and higher lows, which is bullish. You get your low, high, higher low, higher high at some point in history. The last time that we had another major correction was in 2020. So you got one in 2020. You got one in 2018. And you had one in 2008, which actually I got to pull this out a little bit further. So 2008 and 2000. As you guys can see, they were pretty substantial. We did have one here in 2015-16, but it wasn't really that big. This would have been more like a correction than an actual recession. So as you guys can see, clearly just a bird's eye view. The markets are typically more bullish than they are bearish. I'm actually going to go out further here. So we're going to now go to the 12-month, which this only goes, this really goes back a long time. So as you guys can see, the chart pretty much goes all the way back to 1871. But I mean, if you just look at this thing on kind of the overall picture here, you can see that stocks have really only ever pretty much gone up over time. and increasingly more so as time moves forward. So when you're down in your positions, keep this in mind. Time in the market is much more important as an investor than timing the market. Timing the market is more it's more targeted towards traders, day traders, and swing traders. We do that, but we've had to perfect our different strategies for different things that we do in the market. So we day trade futures, we swing trade stocks and crypto. So we've had to learn how to time the market based on day trading and swing trading strategies that are profitable. More often than not, with back testing and things of that nature, that's stuff you're not typically going to look at as an investor. As investors, especially with your dividend snowball growth, the idea is to have more time in the market and not so much be concerned about timing the market. So there are ways to basically ensure that you are able to buy some of these stocks on the dip. You can use the SPX or the NASDAQ even as a reference point for potential dips coming in the market, which you can then look at the individual stocks within those indexes to determine what you want to buy, whether they're paying dividends or not. Another one that we also look at is we look at the stocks above both the 50 and the 200-day moving averages on both of the major indexes, the S&P and the NASDAQ. The main one we use is the S&P because that's the gold standard. For short term, we would use the 50-day. For long term, as more of like a long-term investor perspective, we would use the 200-day. You can see that the support and resistance touches much more often with the 50-day. So basically, the perfect time to buy stocks at a discount with, obviously better dividends, more money, more bang for your buck, right, would be down here. And the ideal time to sell, if you were going to sell for profit, would have been up here. Or to, if you didn't want to sell, you could have basically just, as this thing is going down, you could have bought into it. So number one, markets are bullish more often than they are bearish, and time in the market as an investor is better than timing the market. So the number two reason would be time itself. So every single time you sell for a loss in a particular position, you are losing time. So what do I mean by this? Well, as you guys can see, we're in a drawdown on Tesla here, just shy of $2,000. If you want to include the dividends, it's actually less than $1,000. But here's what I mean by this. Let's say that you make $25 an hour. Okay, that's your hourly wage at your job, and you took a loss on this. So if you were to lose $1,900, let's say, you divide that by the amount of hours you have to work, it would take you nearly 2 weeks pre-tax money, 2 weeks pre-tax to make all that money back. Now, we're going to assume that you have to pay a 20% tax rate, so we'll add that on top just to get our net number. So you would actually have to make $2,280 in order to basically, you'd have to make $2,280 gross in order to net $1,900 to make all of that money back, which, as you guys can see here, it takes a whopping 91 hours of labor. That's assuming you only make $25 an hour. So it would take you over 2 weeks just to get your principal back, and you would still have this realized loss, and that also affects your dividend snowball because you don't have those shares going to work, producing income for you on your behalf. Now, the opposite is also true. If you sold for a $1,900 gain, you are making 76 hours of labor, free money that you didn't have to go to work for. And in the process of that, you're also collecting money from your job or whatever other sources of income you have. And keep in mind, this is pre-tax. If we go back with our other original number, which is post-tax money, let's say that you doubled your money. In this case, you made $2,280. Divide that by 25. So you gained 91 hours of time. That's time that you didn't have to work for, that's inching you so much closer to early retirement every single time that you do this. Again, patience is key. Time is essential when investing in dividend paying stocks. If you take losses, every time you take a loss, it's going to take that much longer in terms of hours, in terms of time, in terms of hours of labor, and how many stocks that money can buy. Okay. Versus if you take a gain, it's going to shorten the amount of time that it takes you to get to an early retirement, or to get to a point where you can transition to like maybe a part-time job or something, or you can live off of the income and have a roommate or whatever your preference is. So time in the market is key. The ideal situation that we like to try to abide by is when the markets are up, we'll take profit and then we'll DCA back into those positions or other positions on the way down and collect more passive income on the way down, and then flip it when it goes back up. We'll start taking profit on the way back up and just rinse and repeat as time moves forward. So that's reason number 2. Time in the market beats time, or time in the market beats time in the market. You cannot get time back. The more losses you take, the more time is required to return the initial investment back to par or back to break even. And number 3 would be live examples out of our own personal portfolio. So we've pretty much already showed you guys what would happen if we had been impatient and sold for a loss. Again, we make more than $25 an hour. We'll just say that between all of our sources of income, it's pretty substantially more than that. But regardless of what the amount per hour is, the bottom line is if you took this loss, you would have to make that money back somehow. And you would be out of the position, which means that you're no longer able to take profit on this position when it goes back up to break even and or above. So we're going to take a look at another example in this portfolio. We will take a look at Horizon Technology. This is a good one. We've done pretty well this year on this one. So we haven't really had a lot of money in this. I would say our maximum shares that we ever had was like 60 or 70 in this position. But between collecting dividends and taking profit when the market gave it to us, we were up $128, 46% on the year. And keep in mind the share price is actually down right now in comparison to our cost basis. So if it was up, we would probably be up in terms of numbers and percentage gains much more than this. But let's take a look at the underlying stock and see what would have happened if we had been reckless with our trades here or our investments. So we're going to go to the 4-hourly chart here. Or actually not the 4-hourly chart, we're going to go to the daily chart. So you guys can see that it kind of ranges around. The areas that we took profit in were basically pretty much right here between March all the way up to July. So the bottom was at 11.53. The top was roughly at 13.40. So you're talking about a $2 spread there. Let's try to measure this based on support here. So upside potential would have been about 17%, whereas downside potential would have been about 13%. There's a term that we like to use in trading, and that is if you lose 50% of your money, you got to make 100% to get it back. And I've given you guys this analogy before. So I'm going to show it to you one more time. If you take $1,000 in a trade, this is not pertaining to investing, but the concept here is the same. So if you take a 20% loss on a trade, you lose $200. Now your initial investment's at $800. Well, in order to get back to that $1,000 mark, you now have to make $200 to get back to that, or you have to make 25% to get back to $1,000, whereas you only had to lose 20% to get to $800. Now, if you wanted to make a 20% gain on that $1,000, you would only have to make 20%. Whereas if you wanted to get to $1,200 from $800, you would have to make 50%. So this is something to keep in mind every single time you decide to be reckless with your investments and your trades. Again, we can't give you advice as to what to do, but we've given you guys our strategies. So if we had been reckless and bought at the top and then sold here at the bottom because we got emotional, we would have taken about a 13% loss. Whereas if we had timed this perfectly, we would have made about a 16% gain. And again, we don't buy exactly at the bottom. We don't sell exactly at the top. We kind of more or less scale in and out of our positions depending on what the market does. When it gives us profit, we scale out. When it gives us dip and buying opportunities, we scale in. It's not a perfect science, but it's been pretty effective for us for the last 12 months. So here's a quick article I'm going to leave in the description for you guys about how to build a dividend snowball if this is something you're interested in. As you can see, the metrics here. If you just sat on cash versus getting paid dividends and not reinvesting versus reinvesting the dividends, you can see there's a pretty clear night and day difference here. So I'll leave this in the description for you guys to look at, but here's some additional ideas to be able to compound your dividend snowball over time. So anyways, hope you all enjoyed this video. Please like, comment, and subscribe. We'll see y'all later. Peace.